Hi there, I'm James Strode, publisher of the Global Legal Insights to Fund Finance. Joining me today are Lindsay Trapp and Christopher Duerden, both partners at Dechert and operating out of their Charlotte office. Lindsay's practice is all about supporting asset managers and sponsors in the structuring and formation of complex credit funds, including rated note feeders and captive CLOs. Chris is part of Dechert's leading global finance team with a focus on securitization, capital market transactions, and with that, he leads Dechert's structured credit and CLO team. Both of you, thanks ever so much for joining.
Thanks for having us.
Lindsay, I'll kick off with you because Dechert's Pink Book chapter this year focuses around collateralized fund obligations. If you don't mind, can you just provide a brief summary of what a CFO is?
Sure. A CFO is essentially at its core a securitization of secondary fund interests. So if a CLO is a securitization of loans, very similar in structure and the methods by which it operates, but here the underlying collateral is limited partner interests in a number of underlying private investment funds, typically.
Fantastic. And Chris, just with that very brief introduction of a CFO, can you just explain how the fund finance industry and CFOs have collided in recent times to see the explosion of interest that there is?
Yeah, sure. I mean, I think that a lot of the things that you see in the market, some of these products, including CFOs, have actually been around conceptually for some time. Maybe with the exception of NAV financing in terms of some of the newer quote technology that you're seeing. So a lot of these things have been around, but what's happening is they are exploding, if you will, because of the natural evolution in kind of overall fund finance and a desire for greater liquidity on the part of LPs in that space. Or generally within private funds, but also a desire from managers and sponsors to figure out new ways to bring in greater investment from investors who, have for various reasons, but typically for capital, relief or capital balance type charge issues, can only invest so much directly into a private fund, right? So clearly we're talking about insurance-based money. Insurance-backed investors. So I think, again, you're just seeing a natural evolution, in regards to fund finance, because, again, you've got things that have kind of been there. And now I think you've got more creativity, more of a willingness on the part of, lenders, borrowers, investors to say, okay, this is kind of where we are in the life cycle of certain private funds. Here's what's happening in the greater kind of macroeconomic arena. Let's see how we can do some things to, kind of get creative, enhance returns, and again, spur greater investment overall.
Yeah. Okay. So look, really positive transaction type and product there. The CFOs, you're painting a really rosy picture of evolution and creativity, Chris. But surely from both of your positions, advising your clients, there have to be one or two considerations, right, before running this type of transaction. So, Lindsay, your thoughts on those particular considerations?
Yeah, absolutely. So I focus on CFOs from the collateral perspective as opposed to the securitization perspective. And there are a number of things, right? You're not dealing with just loans, you're dealing with investment funds, which will have a number of considerations around them, and you are transferring those in. So similar to large secondary book transactions, you have a number of things to think about in relation to the underlying funds themselves. Key things that you'll ultimately end up going through are things like, what are the transfer provisions within those fund documents? We will need to go through each and every fund that you're expecting to be in the portfolio, go through the limited partnership agreement, deal with any side letter provisions, and ensure that we can actually make this transfer. So it ultimately ends up getting sometimes complex with general partners and asking them, for permission to do this. oftentimes people will think, well, it's not really a transfer, it's going to be securitized, but ultimately it does end up being that way because you're going to, secure that interest. And if there were some sort of default, ultimately the note holders would be able to step in and be limited partners. So there are a number of considerations. You have thoughts and considerations as well around qualification of the vehicle itself for things like accredited investor, qualified purchaser requirements, making sure all of those things kind of come together. And then one of the biggest considerations is time and timing. A number of general partners will have specific dates within the year on which they're willing to do transfers. And so what you're sort of aiming to do is line up as much of the portfolio as possible to make sure that you can effect as many transfers on the date of closing as is possible. And ultimately, you may end up having to get all of the transfer things in order, but perhaps you close in the middle of a quarter, or perhaps that general partner only allows transfers twice a year. And so then you may have to wait to get the rest of the portfolio into the structure. On top of that, there are other considerations around things like liquidity, because all of these funds, will have different stages in their life that they're going through. And you may need to deal with your contribution requirements to draw down funds. So you have to consider things like, do we need to have a liquidity facility within the structure? Should we set up some sort of other fund that acts as more of a, financing type of arrangement so that we can take money in and out of it in order to be able to fulfill those capital calls? So there's a number of very fund related considerations that go along with this, on top of all of the things that Chris, I'm sure you can talk about on the securitization side.
Yeah, absolutely. I mean, it's CFOs are a complex product, and I think though they are an asset class from an investor perspective, I think the way we tend to think about CFOs is they're more of a solution. It is a product driven to help resolve, something that, either investors or manager or sponsors or LPs are trying to solve for, right? So kind of with that context in mind, it's different from like a CFO, or I'm sorry, a CLO, right? Where that's clearly an asset class. It's an investment vehicle. Here you're trying to marry up a lot of different parts. So in addition to what Lindsay was talking about, just kind of before you even get going on the CFO, you've got to spend a lot of time with the rating agencies, working through the cash flow, dynamics. What methodologies are they going to apply for the ratings? How is this going to make sense? If you've got, what type of funds are going to kind of comprise the actual CFO? What will be their cash flow? Do you need to have some sort of reserve, liquidity facility? What are investors in the deal going to require? Are you going to try and sell some portion of the equity in the CFO? What is that going to mean? What are the investor stipulations going to mean? You've kind of got the NAIC overlay as well. So if you've got insurance-based investors, you're going to have to keep that in mind. And that continues to be a moving target. But in general, the way CFOs are kind of continuing to evolve is there's a heavy emphasis on the cash flow, right? So if you're looking to put, I guess a better way to put that would be, if you want to do a CFO nowadays where the underlying funds are purely private equity based funds, you're going to have a very, very hard time getting that CFO done, if only because the emphasis, again, from NAIC, investors, rating agency is, gee, we don't think we're very comfortable just continuing to defer interest ad infinitum until you have a liquidity event at one of the underlying funds. So you're really looking, and this is actually though what makes CFOs so interesting and why you're seeing so many of them, is because I think that there was a market before that said, oh, why would I use a CFO? How could that help me? But now you've got all these direct lenders out there with credit op funds or big institutions that have a variety of different funds with different cash flows. And they look at that and say, hey, you know what? In the aggregate, if we do this could make a lot of sense. So, this is basically my way of saying there is a lot of thought process that goes into a CFO before the lawyers even really put pen to paper. And that's something that we really try to emphasize with our clients is these things will not happen overnight. They're going to take a lot of time. You're going to, whether you're working with an arranger or not, and most people are going to work with an arranger at this point. A lot of conversations with the rating agency, a lot of conversations with investors. Things will pop up that you don't necessarily, think about at the beginning. So again, very, very unlike a CLO. Looks like a CLO in a lot of respects. You'll see a lot of CLO kind of terminology and whatnot. But whereas a CLO can come together very, very quickly, a CFO will not.
And that there is why you guys are kept busy then, with those explanations. Look, I appreciate that, and you've touched on a few of those buzzwords that the industry are focused on. I'm thinking ratings, liquidity, that kind of thing. Just from your perspective, I'll throw this to both of you, if you like. The fund finance market always evolves every year. We see an evolution. We see new products, driven, as you guys have said, about CFOs by necessity, as well. So against all of that, against all of the products that are out there at the minute, what do you see sort of the CFO landscape being like in 2025?
Yeah, I mean, I can take that first, Lindsay, if you want. I think that we continue to see, as we sit here in January, I think that it's going to be a pretty healthy and robust on a relative basis, for CFOs. I think it will be a relatively robust issuance here because, again, rates, I think, are going to, we knock on wood, but we think things will generally kind of moderate out within a certain range. It doesn't, as we sit here right now, feel like there's going to be a lot more cutting. But, it seems like things will be relatively stable, all things being equal. And so with that, it was a fairly robust year for CFOs last year. And again, I think what you're starting to see in that market is it's almost like the more of these deals that get done, the more of like a proof of concept that kind of gets out there. One of the things that makes it a little bit difficult for the market, at large is these are all private deals. So again, unlike other kind of securitizations where folks can go to Bloomberg or, even tap one of their friends on the shoulder, like, hey, have you seen the PPM for this given deal or what have you? CFOs are private, and it's not generally known in any given year, like, well, gee, how many CFOs actually happened? Some deals are happening and they don't even call themselves CFOs, but for all intents and purposes, they are. And I think that, these things are kind of coming out a little bit more slowly in terms of people's familiarity with them, their understanding of them. And I do think that makes a big difference. That's the same, I think that we're kind of facing on the investor side of things too, right? Like the NAIC, depending on what's going on with there at any given time, that can dampen enthusiasm for this type of product for the moment. But then we get a different, they have another meeting and things don't seem to be finalized. And then, you see kind of the activity kind of ramp up a little bit on the insurance side. What I think is going to help CFOs kind of continue to grow is that what we started to see as the year went on last year is you're getting more of these deals done where they're not solely dependent on insurance-based investment. And I think that's really important, right? So you get new investors into these deals, investors who, let's say, have primarily focused on CLOs. Now they're starting to get more comfortable with what a CFO is and what's happening there. If you can drive some third-party equity investment into a CFO, that'll be a game changer. We're starting to see more of that. So again, this is not a product, if you will, that's just going to suddenly explode. We won't be sitting here in December of 2025 talking about just a mega amount of CFO issuance. Because again, it's a solution-based product. But I think it's going to continue to grow. I think I think you will have a number of folks who are first-time issuers continue to get involved. And so I think on the whole, we see it as being a pretty healthy market. And again, a CFO is not that far from a NAV financing. And NAV financings are taking all sorts of different forms and a lot of creativity in that space. And so I think, again, as more and more people start looking at NAV financing and they look at a CFO and say, oh, well, wait a minute, that's not that far away. Maybe in this context, a CFO makes more sense, or NAV, makes more sense here. So I think as fund finance kind of continues to evolve, continues to grow, becomes more complicated, within that larger umbrella, you've got CFOs, and I think that they'll continue the issuance, and will continue onwards and upwards in 2025.
Yeah, I would agree with that. I mean, my practice focuses in different methods of bringing in capital to funds, or different ways to lever funds using rated issuance. And I think CFOs just slot nicely into that, kind of panoply of things that have grown up over time, including rated funds, leverage rated issuers, standalone issuers that are rated under a funds methodology. And they are a solution for general partners that are looking to have access to capital for a number of their different funds, but they're also a very good solution for, larger institutions that are looking to free up space in their book. And the more of these that can be done, that means that there's more capital to be invested in the wider private funds market. It is interesting to watch how the NAIC's developments have happened. Now we have the new principles-based bond definition in place. So I think that's definitely, over the last couple of years, and will particularly now going forward, it's going to have an impact on the portfolios that can go into these, being a lot more credit-based CFOs, and I think we'll probably continue to see that. But you'll also see possibly more mixed asset CFOs. So maybe a mix of private equity funds and private credit funds, possibly having CFOs that will invest directly into income-bearing instruments on top of fund investments in order to keep that liquidity profile up. So it's, as Chris said, probably not going to be sitting here talking about 500 CFOs being done at the end of the year this year, but definitely I think that we will have quite a number of them, and it's just going to continue to evolve and develop as people get comfortable with the technology.
Yeah, super. Thank you, Lindsay, and thank you, Chris, as well, for those insights. You can read more about CFO and more of those technical points that Lindsay and Chris have touched upon, and the trends and developments in the CFO market within this edition of the Pink Book, which is available online, free to access, and across the Fund Finance Association's web pages and symposiums that they put on as well. So all that's left for me to do is thank you again, Lindsay and Chris, for joining, introducing your chapter into this year's Pink Book, and having that discussion with me today, and all the best indeed in keeping you guys busy with CFOs over the next 12 months.
Thanks so much for having us, James.